Hi, this is Jeff Hirsch here with Dr. Alan Ellman at the Money Show in Orlando, and Dr. Ellman is the head of the Blue Collar Investor Corp at thebluecollarinvestor.com. Covered call writings is your bread and butter. Give us the basics. Why do people want to be covered call writing, and what are the instances that they want to be doing that, and how does it work?
Covered call writing is a strategy where you can generate regular cash flow into your brokerage account, leveraging stocks or ETFs, exchange traded funds, that you already own. The main advantage is that what you're doing is you're on the sell side of options. So that implies that once you sell an option, cash is being generated into your brokerage account. So the way it works is you purchase at least 100 shares of stock. And the reason I say that is because one options contract is the equivalent of 100 underlying shares. So let's say you purchase 100 shares at 48, that means you have a cost basis of $4,800. Now, once you own those shares and you are in a covered or protected position, now you're free to sell the option. So let's assume for a moment we decide to sell the $50 call option, which means we are selling the right but not the obligation to some unknown person to purchase our shares for $50 at any time by expiration.
Why above the price that you paid and not below?
Well, in a bull market or even in a normal market, it's advantageous to us to sell a higher price called an out-of-the-money strike price, because it allows us the opportunity to generate two income streams in the same month with the same cash investment. One from the sale of the option and the other from share appreciation from the 48 price up to the 50 strike.
So this is not a strategy. The old school covered call strategy was you had these long-term hold positions that you were holding, and you would write covered calls to reduce your cost basis. This is different than that, it sounds like.
This is different in that we're looking to generate a regular cash flow. Now, if you have a long-term buy and hold portfolio with stocks perhaps at a low cost basis, perhaps generating dividend income, and you want to increase that return by writing covered calls, you could use covered call writing, but in a slightly different way, because you're going to go deeper out of the money, which will reduce the risk of assignment or your shares being sold, thereby worrying about tax issues.
Great. Thank you very much, Dr. Ellman, and thank you very much for joining us.